following program is to provide entertainment and information. It is not considered to be any legal or investment advice.
Good morning, appraisers. Let's talk some real estate. You're listening to the Voice of Appraisal, the #1 appraisal podcast in all of America that always brings you the latest news and information from the front lines of the real estate market. Anything from market conditions, appraisal regulations, cryptocurrencies, big bang news. Folks, you have a question, we have all of your answers. We are the one-stop source for all of your real estate appraisal information needs. If you want to be in the know, you have definitely tuned in to the right show. I'm your host, Phil Crawford. Happy to have all of you here with us today. Kevin, how are you, my friend? How are you today?
I'm doing good. Last show was really good, but
last show,
I think this show is going to
be explosive. We've got John Russell joining us today on the podcast. We're going to break down some of these executive orders that President Donald Trump has signed, what impacts that's going to have on the appraisal industry, on appraisers altogether. I'm going to pick his brain a little bit. President Trump signed a massive amount of executive orders, didn't he? I think he's signing so many of them, I don't know how it's going to impact us. So, and I kind of like executive orders a little bit. My favorite executive orders, if you want to look them up, are 13818. That's one of my favorites. Also, I like 13903. And I think as of today, Kevin, President Trump said he's going to declassify the JFK files and the Martin Luther King files, right?
I wonder what secrets are in there.
I don't know, but if you look at the JFK files, I wonder if Executive Order 11110 is going to be part of that story. 11110, one of my favorite executive orders signed by President Kennedy. So for those of you out there in California, I do want to say that you are in our thoughts, in our prayers. My father-in-law is impacted by these fires indirectly at the moment, and hopefully it will stay indirectly, but he's right in the middle of that mess. He's off of the Valley Circle exit. I give you a more specific location, but I don't want to have doxing George Hatch out there putting his address out for everyone to see. But no, he's right in the middle of that mess. The entire country right now, of course, is fire and ice, fire in California, and, of course, ice out here in the Midwest. So our thoughts and our prayers go out to those people in California. Get ready for those markets. Get ready for that rental market to make an active change. You know it is. There's been talk of price gouging in the rental market. Get ready for that inventory to decrease more and more. It's going to be a mess out there in California, and you're going to need to have the appraisers on target and on the mark, and there should be no more appraisal waivers, especially in Southern California. Terrible idea. We do not want to have any more data cancer flowing through the Southland.
They just need to quit pissing in the wind.
They are pissing in the wind, and we don't want to talk about wind. Did you hear the situation with Joe Rogan? Did you hear the Joe Rogan interview from 2024 about the wildfires in California? He was talking to that firefighter. Go ahead and play the soundbite, Kevin. Go ahead and play the soundbite. Joe Rogan, 2024. Listen to this really quick.
I talked to a fireman once, and he goes, dude, one day, he goes, it's just going to be the right wind, and fire's going to start in the right place, and it's going to burn through L.A. all the way to the ocean, and there's not a thing we can do about it. I go, really? He goes, yeah, we just get lucky. He goes, we get lucky with the wind. He goes, but if the wind hits the wrong way, it's just going to burn straight through L.A., and there's not going to be a thing we can do about it.
I mean, think about that. Think about that for just a minute. That's absolutely unbelievable. And that's exactly what's going to happen in 2026 when they say, you know what, one of these days, the appraisal waivers, the pissing in the wind. The pissing in the wind is going to go out there and it's just going to burn. It's going to burn right through the entire financial system. And we're going to be like, yep, there we were. Yep. There we were. That we were just like Joe Rogan in 2024 because it's going to take the right amount of pissing in the wind, the right amount of time, and then burn right through the entire thing. I've been slamming the GSEs on LinkedIn recently with a meme fest. I've had a wonderful meme fest when it comes to appraisal waivers. We're going to put a couple on the screen right now. Having a great time with it. Let's see what happens. We're going to talk to John Russell a little bit about what is going on with the FHFA and what could possibly be Dr. Mark Calabria's role in the Trump administration coming forth. So a couple other things before we have John on the show. Let's talk about Mark Verrett. Mark Verrett and Jeff Morley, they've got the Market I Like Your Moves podcast. Mark Verrett talking a little bit about the data cancer situation. Got a lot of heat over the last couple of weeks about the data cancer, about the situation that was going on in my backyard. Again, I don't want to put that information out too much. Doxing George will get a hold of it. But we basically put out there in crayon how data cancer works and how one sale can impact an entire market area, especially when it comes to the homogeneous housing stock neighborhoods also known as the cookie cutters, right?
Just
And
that one sale.
that one sale can juice the cookies. And listen to what Mark Verich said on the Market I Like Your Moves podcast. Go ahead and play it.
One single sale, my goodness, if you buy a house, the last thing that you want is to see 20 appraisers over the next 6 months coming to take a picture of your house because you overpaid, right? Because that appraiser needs that sale to make the next 6 months of sale prices. And
yes, that's it right there. That one sale, and all of the appraisers are going to use that one sale to make contract price for the next 6 months. Kevin, we were 100% correct when it comes to the data cancer phenomenon. The appraisal waivers are juicing the cookies. They're juicing the cookie cutter subdivisions. This is causing havoc. This is causing chaos, especially when it comes to increasing property taxes for those people that live on fixed incomes. Maybe they don't even have a mortgage, but yet their property taxes are increasing. Insurance premiums going through the roof. I talked to an insurance agent the other day. He says, you're up by 35% on your rental portfolio. You haven't seen anything yet. You have no idea what's coming when it comes to insurance premiums. The DTI is all messed up over there. The debt-to-income ratio at Fannie Mae and Freddie Mac. This is absolutely unbelievable. And now more than ever, we need to have leadership in the appraisal profession. Unfortunately, we don't. We don't, because something happened just in the last couple of weeks here, Kevin. The Appraisal Institute put out. You're not going to. I mean, this is really bad. Okay, this is really bad. So the ARC group, okay?
Right.
The Appraisal Regulation Compliance Council. They put out a study showing that the appraisal management companies have siphoned off $12 billion worth of undisclosed fees from consumers since 2013. So ARC puts this out last year. It caused a big, bit to do, is a big kerfuffle and everything else. Well, Business Insider picked up on it. And Business Insider did a phenomenal article about ARC and about the $12 billion in undisclosed fees from consumers. All of these things. It was a great article. It was an awesome article. And I guess the Appraisal Institute got all butthurt that they called ARC instead of the Appraisal Institute. So then the Appraisal Institute, in their infinite wisdom, put out this statement on LinkedIn, and this is what it says here. It says, and this is from the appraisal. Look there, that's the logo right there. Okay, this is from the Appraisal Institute. It says here, a Business Insider article highlights the need to require disclosure of appraisal management company fees to consumers. Then underneath it, it says, the Appraisal Institute has fought this requirement for more than a decade, as consumers have been bilked and appraisers have faced crammed down fees. Crammed down. Is that proper? Cram down fees.
Yeah, that
Are you
just
allowed
doesn't
to
sound-
cram down?
Yeah.
They continue. This remains a core pillar to our advocacy for the profession. So in other words, they're all butthurt because Business Insider called ARC, and they're saying, well, we've been discussing this for a long time too, because you guys are getting all crammed down. You're getting crammed down.
So basically, you're telling me the Appraisal Institute wants the ARC to be sunk.
They want They want to sink the ARC. They want to sink the ARC. And the reason why is because they're inept. They're not doing anything. This is like, you know what this is right now? This is like if you have a friend that's an alcoholic, and this is like the moment you have the intervention. This is the moment, because they're at the bar and they're faced and they're saying, we've done it for a long time, and all of a sudden the ARC people came over and we're going to sink the ARC, the stupid motherfuckers. That's what this is. It's amazing because I've met a lot of people from the Appraisal Institute since we did the Cindy Chance show. And a lot of the Appraisal Institute members have reached out to me via LinkedIn. I've connected with them. And I'm going to say something right now. You guys, you're very impressive. Okay? No, I know. I'm not bullshit when I say that. I mean, these guys, these people are impressive people. They have impressive resumes. They have come from impressive schools, some of the top business schools in the country, right? Instead of just the MAI and the SRA, they've put a lot of money, time, energy, and effort into their education and into their branding. And they deserve so much better than this butthurt, drunk-ass statement that the Appraisal Institute put out. You guys have got to get a hold of this leadership. You've got to get a hold of it because they're going to damage your branding. I mean, there are 10,000 designated members, all right? 10,000 designated members above ground. They've got some that are below ground, too, that are not not paying their dues at the moment, but that's okay. That's a totally different show. You guys have got 10,000 people. Go out there and get control of this organization and get control of it quickly, because here's the deal. They're not going to take, I know why they're butthurt. They're butthurt because Business Insider and the mainstream media are not calling them to discuss the issues of the day. They're discussing issues of the day with ARC. They're discussing issues of the day with Phil Crawford, Voice of Appraisal, Jonathan Miller. They're discussing those issues with these people, the movers and shakers, not the Appraisal Institute. Because the only questions they're going to be answering from the mainstream media is, what happened in the Cindy Chance firing? Cindy Chance is the open wound at the Appraisal Institute that's not healing. It's not healing. It's still open. And what's the amazing part is that unless they get through that, that's the only questions that they're going to be asked is what happened to Cindy Chance? Why did you fire her? Was she sticking up for residential appraisers? Was she questioning the ethics of the REVA rooms, of the appraisal management companies? All of these questions are going to start until you get through this. No one's going to call you about anything, policy or anything else. No one's going to call you about it.
Right. And the thing that points out to me is with her topic being like an open wound.
Sure.
Everyone's going to be picking at it. What happens when you pick at an open wound? It gets infected.
That's like really gross, Kevin. That's like really gross. I mean, you went there. Why'd you go there on that? Then it gets all like pussy and stuff like that. I mean, what the Kevin? You're killing me. But yes, you're right. It will. I think it's already infected. I think it is. I think the brand is looking at some damage unless you guys, and I'm very impressed with a lot of the people in the Appraisal Institute, get a hold of this leadership. This is pithy. This is just a little pithy little thing. They got in Business Insider. No.
They went to somebody instead of us.
They went somebody else instead of us. I know that bugs them. I know that drives them crazy. Listen, you deserve better. Go out there, get a hold of the organization, and shut them down. And if that leadership is out there, and I know you guys pay a lot of money, if that leadership is out there screwing you over.
We've been ratted out here, boys. Watch it.
Watch it. I love that shit. One more time.
We've been ratted out here, boys. Watch it.
Yeah, you better watch it. That's all I got to say. Jack Nicholson knows what's going on.
We've been ratted out here, boys. Watch it.
You guys get together and you find out what's going on in Chicago. I mean, Kevin, of all places that they have to have their headquarters, it has to be Chicago. You go up there and you find out what's going on in Chicago. And you make sure they're looking out for your best interest as a membership organization, because you deserve better.
We've been ratted out here, boys. Watch it.
Watch it. That's all I got to say. Okay. So, Kevin, that's it. I think we're getting into enough trouble already. Let's not cause any more controversy today. Let's go ahead and play our interview with John Russell. Ladies and gentlemen, please enjoy. And ladies and gentlemen, we have a very special guest on the Voice of Appraisal podcast today. We have John Russell, my friend for many years, is joining the podcast. John, how are you today, my friend?
If I was any better, Phil, I would be your brother. How are you doing?
I'm doing great. For those of you that don't know who John is, John, go ahead and give a short little introduction about yourself and what you've been doing in the appraisal industry.
Up until last September, I was the Strategic Partnership Officer with the American Society of Appraisers, ASA. And at the 15-year mark in my time at ASA, I decided it was time to try something new and different. So I struck out on my own and started a consulting company, Value Site Consulting. We work with individuals and organizations to find business development and growth for valuation-aligned people, valuation-aligned organizations. So that's what I've been doing for the past few months, but also trying to do a bit more writing, a bit more thought leadership. I was really happy to get some time back in my life to sit in front of a keyboard and put some thoughts down, and that's been really well received. So it's been a lot of fun.
Well, we appreciate all the work and dedication that you've had to the industry. I've known you for a very long time. Of course, you were one of the sponsors at Appraiser Fest 2018. The ASA was there, and in large part because of you. And you've done a great amount of work for appraisers throughout the country. You've always been a very good advocate for real estate appraisers. Let's get into it. You handle things, or you break down things a little bit better than I do when it comes to what's going on in Washington, D.C. Of course, we have a new administration, and this administration is throwing out executive orders left and right. I don't really know what some of these executive orders are. I know that, they blanket a lot of things, but can you tell us briefly, and today is Thursday, by the way, the 23rd of January, and President Trump has maybe signed over 100 executive orders as of right now. Can you give us any idea as to any of the EOs, how they're going to impact real estate appraisers moving forward? Is it too early to say at this time?
Well, so a couple of big things that have come from President Trump since he took office earlier this week. The big one that was noticeable was the DE&I, diversity, equity, and inclusion rollback. that has been going through the government. For folks who've been paying attention, they've noticed that all of the content on the Property Appraisal and Valuation Equity Task Force website is gone.
Okay.
That got swept up in that entire DE&I rollback from the administration. So that's, tangible evidence of not just what they're going to be focused on, but how quickly they're going to get things out the door. Just as a general matter, I'd make the observation compared to the first time around with President Trump and his administration. You can tell there's been a lot of forethought, a lot of planning and preparation on their part. I think when they first came to Washington, they didn't necessarily have the depth of talent to effectuate the policies as quickly as they wanted to. And you're seeing this time, this is an incredibly professional outfit. They were very well prepared for everything that they wanted to do. So obviously DE&I was one of them. We've seen around the federal workforce, they've frozen all hiring. They're trying to push out folks who are still within their probationary period of a year. That's been one of the stated goals, is to really reduce the federal workforce, bring folks back to the office, things of that sort. Trying to rename some large bodies of water. We'll see how well that's received by the broader public.
Yes.
And then the other thing, the other day, actually, it was just today, President Trump made a remark basically saying in so many words that he wants interest rates to come down.
Yes.
Basically a direct shot in the direction of the Federal Reserve, telling them, hey, we need monetary policy to start bringing the interest rates down so that people have more of an opportunity to buy homes and refinance homes. And obviously there's a lot of complex factors, as you know, Phil, and this audience knows, that play into that. I'm not going to try and play expert on the Fed funds rate and the 10-year Treasury. But there's a lot more that goes into it than just saying you want it to go down. But we'll see if that does have an impact on the willingness, at least, of the Fed to look at that funds rate and consider a cut that they weren't otherwise considering.
He made that statement in front of the World Economic Forum. It maybe will have a big impact. The World Economic Forum, the look on some of their faces during that speech was absolutely hilarious. I was actually dying through some. I'm not a big fan of the World Economic Forum sometimes. Also, let's talk about his, I guess appointment would be the word, taking Sandra Thompson's position is a gentleman by the name of Mr. Pulte. Am I right about that? A builder, or coming from a builder family who's going to be in charge of FHFA?
Yeah, Bill Pulte comes from the Pulte family. If you're familiar with Pulte Home Builders, the family themselves not too much involved in the business anymore. They have different leadership in the executive suite. I know Bill Pulte, I believe, still owns an interest in the company. But what's interesting to know about Mr. Pulte is he's actually a Wall Street type, comes from a finance background, an investment background. So, kind of high level, how would you interpret what he might be focused on? We do know as a broad policy goal, the Trump administration wants to recapitalize and release Fannie Mae and Freddie Mac from their interminable conservatorship that has existed since the prior housing meltdown in 2008, 2009.
Yes.
So that's going to be the primary mission for anybody in that FHFA seat. And so when you look at someone with a finance background, with a Wall Street background, you start thinking about, well, maybe his motivation or his focus is going to be ensuring that when they go back into private ownership and out into the markets, that there's a lot of value creation there for shareholders, folks who've been holding on to their preferred stock forever and a day. See what direction he goes. I will say, I've been having conversations, as many have, in and around the Beltway. Don't take it for granted that he gets through the confirmation process. This may not be an easy in and out the way that people might think it would be.
That's very interesting that you're saying that. In the last podcast, I said, President Trump may want to put online another 2.5 to 4 million units within the next 4 years. I think he'll probably end up getting like 2 million new homes built. It's interesting that he brings Pulte in. And Pulte, if you're interested in him, there was a interview that was done on the Wealthy On channel. I do listen to the Wealthy On channel sometimes. I'll put that link in the show notes inside of the YouTube here if you want to listen to that interview. So it may not be a slam dunk with him, is what you're saying. That's interesting. Very interesting.
Yeah, and we'll see why that might be. And one thing, you did bring up that podcast. I know I shared it with you, and I listened to the whole thing. Yeah, you try to look at the words, the phrases that people use to talk about the critical concepts, how they view the world when it comes to housing finance. And Bill Pulte, on more than one occasion in that conversation, referred to homes generally and mortgages generally as illiquid leveraged assets.
Yes, that's right.
That's not an accidental turn of phrase by him, right? That's clearly the way he sees housing finance and home ownership. And so you start kind of unpacking that phrase, illiquid. right? What does that mean? Well, it's hard to put a home to market. Before you even get to that point, you've got to go through the processes, getting an agent, getting the listing up, doing all the, polishing of doorknobs that you need to do to make it look nice. And then the period of time before you get in a good equity position where you're going to profit from that transaction. So, it's a very interesting perspective, an interesting way that he is framing the conversation around housing. Obviously, we'll see if we get to a confirmation hearing kind of how that evolves, how the various senators kind of tease out of him his worldview more broadly in housing finance and the role of FHFA in relationship to the GSEs, Fannie and Freddie.
Right.
It's always just kind of fun to see what that interplay looks like in a hearing. Even the ones that should be less contentious, you can still find out a lot about someone who's up for a nominated position.
Well, you and I were very shocked at first because we were hoping that Dr. Mark Calabria would go back in to the FHFA position that he had before Sandra Thompson took over, right? But then we heard from Joan Trice that perhaps Mark Calabria would want to go to Treasury instead of FHFA. So can we both agree that kind of what we're going to be looking for is if President Trump puts him into a Treasury position? Do you think that'd be the play that we would want to be looked for?
Yeah, I mean, it'll be interesting to see where and how Dr. Calabria fits in. I'm a really big fan of the work that he did.
Same.
I've not been shy about the fact that I think under Mel Watt and Sandra Thompson that perhaps the conservatorship wasn't treating safety and soundness in the way that it needed to be treated. And I felt that, Dr. Calabria did a better job on that aspect of things and certainly had to navigate the pandemic as well.
Right.
Has a book out about that whole ordeal. So I do think that he has some really interesting perspectives and lessons learned that could be helpful to this second administration. So my hope is he does get a good position, good opportunity somewhere to have a role to play. Yeah, we'll see how everything plays out. And sometimes you don't know what's going to move somebody through a nomination process or conversely what might tank it. So sometimes things just happen. When you're going through these many appointed positions, strange stuff just happens from time to time, and you never know which nominee is going to be the one.
Well, you brought up safety and soundness, and Dr. Calabria has been on a substantial amount of podcasts. He was just recently on the ARC podcast. And he's been talking a lot about the concept of the appraisal being a quote-unquote friction in the process to Fannie Mae. I'm going to play a soundbite with you really quick here, John. This is Mark Calabria. He was on the Valuation Review podcast at the end of the year. And I want you to listen to what he says about the issues with appraisal, with title, and with home inspections, okay? And he's going to bring up this concept of these three professions being a quote-unquote friction to the GSEs. And then I want you to listen to it, and then let's read between the lines a little bit after it's done. So, Kevin, go ahead and play that soundbite right now.
I do want to say is a bigger issue, and I think this is so important for many of the safeguards in the system, like title, like appraisals, like home inspections. The outgoing administration really had this view, reinforced often by Fannie and Freddie themselves, that so many of these things were just frictions. Oh my God, we need to get rid of this because originators don't like it. And how do we, make it easier? One big thematic change is that, as a reminder, FHFA is first and foremost a safety and soundness regulator, like the OCC, like the Fed. Its job is to protect the financial system. It may come as a surprise. Nowhere in law does it suggest that FHFA's job is to increase homeownership rates. Right. That's not there. Right. That's a made-up thing. So to some extent, the current administration, in my opinion, kind of making FHFA into HUD Junior, that's going to reverse. Really going to see it go back to be a safety and soundness regulator and focus on how do you protect Fannie and Freddie, how do you protect financial stability. I think you will see a shift in attitude where there's less hostility to safeguards in the system.
So there's less hostility to safeguards in the system, and he keeps bringing that up. These are the safeguards. Did you notice that title, appraisal, home inspection? He's using the word safeguards when he talks about those professions and how there's been this negative, friction sort of feeling from the GSEs and the originators. What do you think about that? Read between the lines on that. What do you think about that, John?
So, I mean, look, at a broad level, right, the goal of Fannie and Freddie is to keep liquid capital in markets to allow for more mortgages to be made. Their role is one of promoting home ownership by keeping mortgage loans readily at the fore for anybody who can qualify for one.
Right.
But FHFA, and rightfully so, their job primarily is safety and soundness, and especially with an eye toward the behaviors of Fannie and Freddie that created undue risk the last time we went into a housing bubble, right?
Right.
So, again, unfortunately, we've had individuals steering the ship at FHFA over the years who have just basically given the GSEs more or less what they've asked for, and sometimes even what they haven't, when it comes to loosening the reins on those safeguards, on those consumer protections. And I do think we are going to see a bit of a retrench back more in the direction of safety and soundness. But one of the primary challenges you're going to have is, when we're talking about a world where you can do a 97% LTV appraisal waiver on a property data collection,
Go ahead.
even if you retrench to where you were before, you're still at 80%.
I know.
And
I know.
who's to say that's the right or wrong number? But it's still a large amount of activity that could qualify for that type of waiver where that protection, that safeguard is still not being afforded to enough borrowers and homeowners as they go through the mortgage lending process.
I totally agree with you. You saw my show on data cancer, yes? You've got
Phil, it was so amazing. I listened to it twice.
You listened to it twice. I wrote it out in crayon so everybody can understand. And then you did get my postcards, right? I sent you postcards.
I proudly displayed my Voice of Appraisal postcard, the signed one, by the way.
The signed one.
In my background for all of my Zoom meetings.
Dude,
now.
you totally rock, man. You totally rocked. If any of you are interested in getting one of these postcards that I sent to John Russell, you can just email me at info@voiceofappraisal.com, info@voiceofappraisal.com. Give me your name. Give me your address, and we'll send you a couple postcards free of charge. The issue with data cancer, the issue with the appraisal waivers. He's also talking about title, not doing full title reports, doing the attorney opinions. Look, man, you are just watering down so many things. And what's going to end up happening, John, and you and I both know it, is that in the attempt to get rid of the friction in these transactions, Fannie and Freddie are going to open up the door for massive litigation against not only title companies, but real estate agents as well. And I don't think the National Association of Realtors understands that. Let's talk about the messes that the real estate agents are going to have when an appraisal waiver is issued. They don't listen. You're a lawyer, okay? By the way, John Russell is an attorney. By the way, I want everybody
not practicing.
Not practicing.
I don't practice. I just pontificate.
But okay, but that's fine. So you know what you're talking about. If these appraisal waivers are performed and that real estate agent doesn't do their fiduciary due diligence, letting that buyer know that they have to have their own appraisal performed if they want to find out what the property's value is, if they want to make that decision, and also if they don't have any sort of appraisal done to satisfy or fully execute a contract. I mean, is this being discussed by anybody out there, John? And we're talking about contract law
I
here.
have been trying to generate this as a topic of interest within the real estate community over the past month and a half.
Yes.
And I'm starting to get a little bit of traction, trying to get in front of just different brokerages and have the conversation. But, when you go back, I mean, I remember back, 2016, 2017, when waivers were first, they called them property inspection waivers or whatever cute name we gave them at the time to avoid calling them what they were, which was an appraisal waiver.
Okay.
And I remember going and speaking in front of a group of realtors from the Pennsylvania Association of Realtors and trying to explain exactly what this meant for them in terms of you can't rely on the finance contingency to require the appraisal, and you're going to have to think differently about how you're writing your contracts, using your form contracts, etc. Phil, you'd have thought I landed from Mars that day. They didn't have clue one, what was going on, what I was talking about, what this is going to mean for them from a practical perspective. And you're absolutely right. If you have a client as a real estate agent who's getting a mortgage loan and gets an appraisal waiver, and you don't have a conversation with them, there's really two things that should happen, in my opinion. If you want a real legal opinion, go hire an attorney. They're going to probably tell you close to the same thing.
Yes.
Two things should be happening every single time, right? A conversation that explains what the appraisal waiver is and is not for the borrower. Yes, you will get the loan. No, you don't really know what the home is worth, in not so many words. And then a piece of paper that says, we had this conversation, and this is what you, my client, chose to do. I want to go get an appraisal. You could go get an old restricted use report. You could get an oral report. Whatever is going to float your boat. You got one, great. Or you chose not to get one, and you're fine with that too, and you sign your name to it, and you move on, because now you can document. I had this conversation. I informed my client. I disclosed what they might choose to do, what I would encourage them to do. They made a choice, and they signed off on it. If you've done all that, then you're probably better off. It doesn't keep them from suing you subsequently, but at least you've got something to point at to say, hey, we talked about this, right?
Yeah.
My gut tells me in the vast majority of circumstances where an appraisal waiver happens and is accepted, because we know that the offer and the acceptance rate are two different numbers, my gut tells me the vast majority of agents aren't having any conversation around what protection the borrower, the home buyer, is leaving on the table.
No, there's no conversation being done. The only conversation is happy, happy, joy, joy. We're going to go get naked and some sailor want to come hump bar because we're going to closing quicker. I have to ask you, just from a contract position, if the contract has the clause that the property has to appraise at or above the contract price, and nothing is done, no appraisal is performed, is the contract fully executed?
You know, it's a great question, and it depends on one, what your form contract looks like, if you even have a separate appraisal contingency, because some do, some don't, which frankly they probably all should in a world where the appraisal is not assumed in the finance contingency. But yeah, you may have issues around the execution of that contract. And let's remember this too. I always come back to this when we talk about home buying and selling and contracts and what we're putting on the page. There are exactly two parties to every home purchase who write a number on paper, assuming that it's a normal process. The appraiser, who puts a number down, signs it, puts their license number on it, they've got liability, and the buyer's agent.
Yes.
You're the only other person putting a number on paper. You're putting the number that your client asked you to, because that's your job. That's part of your fiduciary responsibility, is that duty of obedience. But you're still the one who put the number down, which means you advised them, ostensibly, that was a reasonable number to put down. So if you're not going to backstop that with an appraisal contingency, you run the risk of, well, if there's no appraiser for them to sue, and 3 years later they can't refinance because they were underwater when you told them they were fine, the only person left standing there is going to be that real estate agent, and that's where they could run into some serious problems downstream.
We talked about that on the Data Cancer show. They're going to find out later on. Even though President Trump wants the interest rates to go down, the bond vigilantes could come in and the interest rates could go back up again. They go to refinance a couple of years from now. They realize they got messed over. It's going to be a bad situation. And they're going to call me. They're going to call me, and they're going to call appraisers like me. Well, actually, they won't. Their lawyer will. And that's going to be my workflow for the next few years. It really is amazing that this is all taking place. President Trump talked about common sense government. Okay, government of common sense. When are we going to bring common sense back to the GSEs? When are we going to realize that when you have the three-legged stool of mortgage acceptance, credit, income, and collateral, you can't take away one of those legs. If you take away one of the legs, the stool falls down. You know, banking, John, and I've said this 100 times over again on the show, banking is not sexy. And if Bill Ackman wants to make Fannie Mae and Freddie Mac sort of this like utility, a utility company is not sexy. It's very boring. Banking needs to go back to being boring again. And if you look at the appraisal waivers and you look at all this stuff that they're coming out with, by the way, they're coming out with this with quite an arrogance, if you ask me. The optics on Fannie and Freddie right now are extremely arrogant, in my personal opinion. And you see all of this, they're trying to make the banking system this big, sexy thing, and I just don't think it's going to work. Your thoughts on that?
I always start from, you got to figure out what the hypothesis of the case is, right? So when the FHFA comes out in October this past year and says we're going to go to 97% with a property data collection, 90% without on the waivers. Well, why are we doing that, Phil? The simple answer is there is not enough product coming in the door for them to turn around and package and sell to the MBS market. That's the long and the short of it. So a lot of these steps that they're pushing toward are in support of keeping product flow moving. It's no different than selling widgets at retail, right? I've got to have enough product coming in, enough material coming in that I can turn around and sell to my customers. And right now, that's the biggest pain point for both GSEs, is they're competing for a market that has very little supply, just like we see out in the housing market generally, where there's still a dearth of supply. And so they're taking steps, and they're using their regulator to allow them to take steps to try and increase that supply or accelerate how fast that supply goes from start to finish. That's the driving motivator behind any decision that they're making. It's not just in the appraisal waiver space. Same with title. Why do we want to have these title insurance alternatives? To accelerate the process, to keep the product flow moving so they can build out more MBS products to sell the secondary. That's the goal. And so when you understand that that's the thought process, that's the driving ethos informing the decision making, you come back around to the whole conversation with Dr. Calabria and how they see it as friction. Because anything that's going to slow that down, particularly in these tight markets, makes it that much harder for them to sell the product they sell. They sell securities.
Right.
That's what they sell. And they
Right.
don't have enough of it to sell to keep everything churning and keep the lights on and keep the line moving. That's the challenge that they're running into. So, yeah, they absolutely want to see rates go down because that's going to increase product flow. But until that happens, they're both competing for the same dwindling share, and you get situations where what are they going to go after? The points they see as friction.
Why can't they say it the way you just said it? I mean, that was very reasonable. You said it in a non-combative, very nice way. I understand what you're talking about. Why come out and try to kick shit out of the real estate appraisers and say you guys are a bunch of morons and we don't need you around? That's the issue that I have with it. You know, that's the optics that I see from the GSEs right now. The appraisers are so stupid. I want to ask you one other question before I let you go. This is actually something that's been brought up to me from a few emails I've gotten. You know, as of February, we are going to be required to show the data analysis that we use to make time adjustments in our appraisal reports, right? And Fannie, even though they're not requiring a chart of some sort, it would be a good idea to put a chart in your reports. And I do know that some of the companies that supply this data and supply this information actually are getting a little hesitant about it because there's an awful lot of liability in making a time adjustment call in a certain region. It's very difficult sometimes on a macro level. Now, here's what I've heard. Freddie Mac puts out, they have indices that they put out on their website. You can go to the Freddie Mac website, pull up some housing indexes, and you can pull up certain data in certain areas. Fannie Mae does not put out their indices. They keep all of that quiet into themselves. The conspiracy theory that I've been hearing from people is that if an appraiser submits a report to be sold to Fannie Mae and the data and information in the time adjustments does not match the Fannie Mae internal data and information, then Fannie Mae is likely to start sending the love letters back out again to the appraiser state boards, sending appraisers up the river saying, look, they're not doing their jobs right. It's totally different than what we're seeing. Your thoughts on that? By the way, that's not just one person. That's not just me. That's several people emailing me on that situation. Your thoughts?
So I've been pretty clear and consistent on the love letter issue, but I'll be happy to restate it here for your audience.
Yes.
And I've had this very pointed conversation with a attorney for a state appraiser board who was entertaining these love letters and treating them as valid complaints.
Yeah.
My simple answer is, if you're a state board and you have a complaint process and Fannie sends you a letter that fails to comply with your state's complaint process, you don't have an actionable complaint. And if you choose to take action on something less than an actionable complaint, that's probably giving the appraiser grounds for countersuit, I would imagine, right?
Yes. Of course.
So I think that, look, I'll say this. If you're Fannie or you're Freddie and you have legitimate concerns with the performance of an individual appraiser based on the work product you're seeing, it is not that complicated to do a formal complaint. It is absolutely within your right as somebody who's an intended user of this report and its contents. No one's telling you can't file complaints. It's absolutely their right.
Right.
The problem comes up when they think firing off an email to a general inbox is sufficient for a complaint against an appraiser, and it's not. Each state has their own requirements. My expectation would be is that they're meeting those requirements every time they have an issue with the work product of an appraiser who does work that comes into Fannie or Freddie. And I don't think that's too much of an ask, too much of a lift, especially given the amount of horsepower under the hood with all their, collateral risk tools that they have.
Yeah, they've got it all.
I've seen the back end with Collateral Underwriter. I have to assume it's the same with ACE.
Yeah.
They have enough sitting there to, I think, fairly efficiently put together an actionable, credible, compliant complaint per whatever state they're in. I think that's a huge lift or ask to make of them in that regard.
And you use the word complaint. In my personal opinion, I think they should treat it more as an FHA situation where if they do have an issue with an appraiser's work, then why don't you perform a small audit? If you're going to make it a teachable moment, make it a teachable moment. But they're not going to do that. And the reason why is because, and I'm going to tell you something right now, John, I've been married for a long time. I know you've been married for a long time. We both married up. And here's the deal. If your wife came to you or my wife came to me and said, listen, you're causing some friction in my life. If those were the words that my wife said to me, you're causing friction in my life, I guarantee you the attorney's already been called. The attorney's already been called. Half the assets are going to be split up, and you're looking for a one-bedroom apartment, bud. That's what's going on in that conversation. When you use the word friction, it's just a scapegoating situation that I don't like from the GSEs, and I think they need to turn it around. Their optics are going to be so important for the next 4 years, especially if they're looking at going into a private position where they're going to be answering to shareholders?
I said this in a different context. I think it's around AMCs and fee disclosures. Like, I have no problem with people wanting to make money. I think we're all in business at some point at the end of the day to make money, to have a standard of living that we aspire to, that supports ourselves and our loved ones and everything that we could hope and desire for, right?
Yes.
So I'm never going to give people grief for being in business to make money, and that's exactly what the GSEs are in business for. I think to your point, what becomes troubling, what becomes problematic, is when rather than just treat everything like, hey, this is our business case for making a certain decision and supporting that business case, there needs to be a scapegoat. There needs to be someone to point at, to blame, to say, well, these appraisers, they cause friction, they take too long, and oh gosh, sometimes their appraisals just don't come in at contract price. And then to point at that and use it as the reason that they're going to go waive up to 97% LTV on a property data collection. If they have a business case to support what they're doing, via con Dios, go forth and do. Support your business case, but understand that at some point, especially if you go back out in the private markets, even with an implied guarantee, there's still going to have to be a price to pay if that business case doesn't hold up and you have the same headwinds you've had previously. But to your point, I think maybe the underlying unease that happens here is that rather than just saying, hey, we're in business to make money and this will help us make more money, they got to point at somebody and hold them accountable for why they can't make enough money.
I totally agree.
To me, that's just, I don't know. Not everything requires a boogeyman, and seemingly every time there's a decision like this, they've got to have a boogeyman to point to, whether or not it's fair, whether or not it's reasonable.
John, thank you so much for coming on. I really do appreciate it. It's been a long time since you've been on the show.
Given the amount of time we've spent talking to each other, the phone call to podcast ratio is entirely out of whack.
I know, it's bad. It's
so we'll
bad.
have to fix that. That'll be our New Year's resolution in 2025.
That'll be the New Year's resolution. I wish you the very best, and you're always welcome on the show. You know that.
Absolutely. Well, thanks so much, Phil. I appreciate it, and thank you to your audience as well for their time today.
And ladies and gentlemen, there was John Russell, the wonderful John Russell. What do you think about that, Kevin? What do you think about that?
That was very, very informative.
He knows what he's talking about. The one thing I want you guys to look out for, number one, is the Calabria appointment. That's the big thing. Will Mark Calabria, Dr. Calabria, be appointed into the Treasury in any way, shape, manner, or form? Let's keep a close eye on that as these executive orders and as things go through when it comes to the Trump administration. We'll keep you updated on that as well. We're working on a pretty powerful and explosive podcast for February. We're going to dig down deep and have an awesome conversation. So you guys hang in there. It'll be okay. We're going to get through it. And if you guys want to have a Voice of Appraisal postcard, an I Love Appraisal waiver, hashtag Stop Data Cancer postcard from the Voice of Appraisal podcast, send us your name and your address to info@voiceofappraisal.com, info@voiceofappraisal.com. And like I told you before 100 times over again, I guarantee you, I will never, ever, ever share your physical address with the docs or doxing George Hatch. We will keep that all private, and we will send you some fabulous gifts and prizes from the Voice of Appraisal podcast. So, ladies and gentlemen, we have come to the end of our show, and as always, I would like to thank you for listening. As we journey through the mysteries and complexities that are, in fact, the real estate appraisal profession, I would like to thank my producer, Kevin Kenny, and our guest, John Russell, for being here for their thoughtful insight and knowledge. God willing, we're going to be back here very soon, continuing to report from the front lines of the real estate market. In the meantime, you kiss your spouse, you hug your children, enjoy your day. Be safe in the field. You've been listening to Phil Crawford on Voice of Appraisal. We'll talk very soon.
We've been ratted out here, boys. Watch it.
Watch it, Kevin. Watch it.
Watch it.